Here is something that has always stuck with me. The investors who usually lose the most money are rarely the ones who made the wrong selections. They are the ones who made the right selections and then did the wrong things with them at the wrong times. Before we get started, what you're seeing is an AI-generated avatar of me, John Wiswell. The ideas, the research, the perspective, all real. We just think this is a pretty cool way to bring it to you. Nobody knows when markets are going to turn. Not professional investors, not economists, not the people running the largest financial institutions in the world. What a central bank decides next quarter, what a political shift does to a sector overnight, what a war does to energy prices, what a pandemic does to the global economy in weeks, these are not predictable. The variables that move markets the most are almost always the ones nobody saw coming. That uncertainty is not a flaw in the system. It is the system. What you can predict is how people respond to it. When markets are rising, investors feel optimistic, confident, and engaged. Then something nobody predicted arrives. It always does. Markets fall. Unease sets in. Fear follows. And eventually, the overwhelming urge to just get out and stop the feeling takes over. That urge is completely human. It is also usually wrong. History has shown us repeatedly that the investors who stayed invested through the most uncomfortable periods, the ones who did nothing when everything in them was screaming to do something, tend to come out ahead of the ones who acted on that fear. Not because they were smarter, not because they predicted the recovery, but because they did not lock in the loss and miss the rebound that followed. Staying invested during a market shock is not passive. It is one of the most active and difficult decisions an investor can make. It requires trusting a long-term plan when short-term evidence is working against it. It requires separating what the market is doing today from what it has consistently done over time. And it requires the kind of discipline that is genuinely hard to maintain when the headlines, the conversations, and your own account balance are all telling you the same thing, that something needs to change. If you find yourself relating to any of this, go check out our video on buffers and downside protection. Having a defined structure in place before uncertainty arrives changes the experience of going through it entirely. It is something we work through with clients all the time, because for a lot of investors, the problem is not the strategy. It is staying committed to it when markets get uncomfortable. Markets reward patience, but patience is one of the hardest things to maintain when everything around you is telling you to do something. Understanding why that urge exists is the first step toward not acting on it at the worst possible moment. Beyond the Ticker exists to be a resource you can trust. Subscribe, like this video, and if someone in your life could use this, send it their way. We are grateful for everyone who has found us. See you next time.